chart today, you wouldn't see a standard trading session.
No, definitely not.
You would see the EKG of a market going into like localized cardiac arrest. I mean, within hours, NASDAQ futures plunged over 500 points.
And gold swung an absurd $158.
Right. And it was all triggered by one man in Europe declaring that the era of central bank handholding is permanently dead. Welcome to Market Recap. I'm your host and market practitioner.
And I'm your co-host and macro analyst.
Today is Wednesday, July 1st, 2026, and the volatility we saw across U.S. equities was, well, it was historic. We had massive intraday swings with the S&P 500 plunging, rallying violently, and then tightly recovering to close down just slightly at 7,483.23.
Yeah, quite the roller coaster.
Truly. So in today's deep dive, we are unpacking exactly how that happened. We'll break down a massive hawkish shockwave sent through the markets by the new Fed chair, the ensuing chaos across yields and tech, and some major multi-billion-dollar updates in the AI infrastructure space.
Just a quick reminder before we jump into the timeline. Though everything we discuss today is strictly for market context and analytical discussion. It is absolutely not personal investment advice or a recommendation to buy or sell any assets.
Perfect. Let's get right into the sequence of events. Session 1. What set the stage before the U.S. session?
Well, the overnight setup was exceptionally heavy, particularly in Asian markets. We saw China's CSI 300 index drop a steep 3.03%.
And the catalyst wasn't an earnings miss or, a localized regulatory crackdown?
No, it was a profound structural shift. Reports surfaced that the World Bank is preparing to end all of its lending programs to China by the year 2031.
I mean, the actual dollar amount of those loans isn't what drove a 3% drop in a major index.
Right, it's the signaling.
Exactly. The market is reacting to the mechanics of global financial plumbing just being torn apart. If the World Bank, which represents Western-led multinational capital, completely steps back from Beijing, it forces a hard timeline on this decoupling narrative.
Yeah, it means China has to aggressively accelerate its own bilateral lending programs.
Which fundamentally fragments global capital allocation.
Absolutely. We are looking at a future where emerging markets will have to choose between dollar-denominated development finance and yuan-denominated infrastructure funding.
And the friction of operating across two distinct competing financial architectures is, well, it's exactly what the CSI 300 was pricing in overnight.
Spot on.
That fragmentation is already dictating the physical flow of commodities, which brings us to the energy picture from earlier today. We had indirect negotiations between U.S. and Iranian officials taking place in Doha.
And those were continuing from Tuesday night right into Wednesday morning, right?
Yes, mediated by Qatari and Pakistani delegations, and focusing specifically on the fragile reopening of the Strait of Hormuz.
Crucially, the negotiation involved the release of $6 billion in frozen Iranian funds.
Earmarked for humanitarian goods.
Right. And as those talks progressed, the energy markets repriced immediately. WTI crude steadily depreciated to $68.10.
Which is down about 2% on the session.
Yeah, and Brent crude fell to $71.17.
We use the phrase tail risk removal as a market trigger a lot, and this seems like the textbook application of that.
For sure.
The market had a massive geopolitical supply bottleneck priced into crude, and the moment that $6 billion concession hit the wire, the risk premium evaporated and the asset mechanically repriced lower.
You're calling it tail risk removal, but looking at this through a game theoretic lens tells a very different story.
Oh, really? How so?
Well, we know from prior session data that Iran has already exported over 40 million barrels of crude since the blockade initially eased.
Right. They're generating massive revenue at these Brent prices.
Exactly. So allowing free passage through the Strait of Hormuz fundamentally saps their primary geopolitical leverage. If the oil flows freely, the urgency for the West to make further concessions drops to zero.
So your argument is that this isn't a permanent diplomatic resolution at all?
Right. The underlying disputes over sovereignty haven't changed. Geopolitical brinkmanship as bargaining leverage only works if you occasionally release the pressure to collect your winnings.
I see.
This looks far more like a tactical liquidity injection, securing $6 billion in temporary oil revenues to build a cash reserve before inevitably turning the screws again.
So the market is pricing in a return to normal. But normal is the one thing neither side has signed a treaty on.
Precisely.
That significantly changes the medium-term outlook for energy equities if the risk premium is just dormant rather than actually destroyed.
Yeah, it's a huge distinction.
Now, rounding out the domestic pre-market picture, we received the U.S. ISM Manufacturing PMI at 9:45 a.m. Eastern Time.
And the headline number missed estimates.
It did, coming in at 53.3, and the employment index actually contracted, printing at 49.7.
But the prices paid component of that data offered a massive dovish surprise, though. It dropped all the way down to 73.
So heading into the U.S. Open, factories were paying less for materials, suggesting the margin squeeze on the manufacturing side was kind of alleviating. So, to quickly wrap up what we saw in the early hours, easing oil tail risks and soft disinflationary manufacturing data set, a surprisingly calm, almost optimistic stage for the morning.
We'll take a very short break here, and when we come back, we'll look at how the Federal Reserve stepped up to the microphone and completely shattered that optimism.
We are back.
Session 2. What moved markets during U.S. trading hours?
Well, the entire market narrative inverted at 9:08 a.m. Eastern Time. Newly appointed Fed Chair Kevin Warsh took the stage for his speech at the ECB Forum in Sintra, and he completely dismantled the Fed's communication playbook.
He officially abandoned forward guidance.
Entirely. No more dot plots, no more telegraphing the next 3 rate moves.
He explicitly stated the Fed is charting a new course, strictly operating in the price stability business because, and I quote, prices are too high.
Operating without forward guidance means the market is suddenly flying completely blind. For over a decade, trading desks have relied on central banks to map out the terminal rate. If the Fed removes that safety net, risk premiums have to explode across every single asset class.
Because you no longer know the cost of capital next quarter, let alone next year.
Exactly. And the reaction across the tape was incredibly violent. NASDAQ futures plunged over 540 points from their high of 30,553.75 down to a low of 30,008.50.
Wow. And the S&P 500 futures swung wildly between 7,505.75 and $7,579.0.
But the real structural damage happened in the bond market. The 10-year Treasury yield spiked to 4.475%.
When the 10-year yield violently spikes like that, it operates like a wrecking ball for corporate debt. Yeah. We saw the ETFs or investment-grade bonds, LQD, and high-yield bonds, HYG, take a sharp dive.
It's the whole concept of discount rates as financial gravity happening in real time.
Yeah, without a terminal rate in sight, that gravity increases exponentially, crushing the discounted cash flow models for long-duration assets like tech.
And we have to look at gold. Gold experienced an unbelievable $158 intraday swing.
Oh, that was insane.
It dove to $3,973 before skyrocketing to $4,131 and eventually closed at $4,044.50.
Capital was frantically tearing up the floorboards looking for a place to hide.
The price action was undeniable, but look, is the market's reaction to Warsh actually grounded in new economic reality? We've seen sticky inflation data for weeks.
Right.
We've seen resilient labor markets. The hawkish reality was already clearly visible in the macroeconomic data. The market shouldn't have been surprised that rates need to stay higher for longer.
You think of an overreaction?
This looks less like a structural repricing and more like a massive institutional tantrum because a reality trading desks willfully ignored is finally being forced upon them.
Well, the data was there, sure, but you were underestimating the value of the reaction function itself.
What do you mean?
Warsh's speech wasn't just acknowledging sticky inflation, it was altering the core mechanics of how the Fed responds to it. By removing forward guidance, he introduced an unquantifiable premium for uncertainty.
Okay, I see where you're going.
Markets can accurately price in a 5% terminal rate, or even a 6% terminal rate, if they have a map. They cannot price in the fear of the unknown. That $158 swing in gold wasn't just repricing the destination.
It was pricing in the absolute destruction of the map.
Exactly.
That makes the volatility much more understandable. They're pricing in the variance, not just the yield. So, to summarize the core of the U.S. session, Fed Chair Warsh abandoned the old playbook of forward guidance, and the resulting uncertainty triggered extreme, unmoored volatility across equities, yields, and commodities.
We will take another quick pause here. Next, we will explore how the AI infrastructure boom is attempting to survive this chaotic high-rate environment, along with a look at tomorrow's calendar.
Welcome back. Session 3. What were the key corporate events and what should we watch next?
We had a major regulatory catalyst for the tech sector late Tuesday. At 6:20 p.m. Eastern Time, the U.S. Commerce Department officially lifted export controls on Anthropic's Claude Fable 5 and Mythos 5 models.
Huge news.
Yeah, Anthropic is now rapidly reinstating global access across AWS, Google Cloud, and Microsoft Foundry.
We've mentioned AI capex as an existential arms race before, and this is exactly why. These tech behemoths are pouring hundreds of billions of dollars into data centers, specialized cooling, and silicon.
Right, the costs are staggering.
And if export controls permanently restrict the global addressable market for their foundational models, the return on invested capital just collapses. Lifting these controls is the pressure release valve.
It allows the monetization engine to scale globally, driving down the unit economics of inference costs.
But that monetization engine is becoming excruciatingly expensive to maintain, especially with interest rates resetting higher. We got two crucial corporate updates that really expose the financial strain of this infrastructure build-out.
First up, reported on Tuesday at 7:09 p.m. Eastern Time, Microsoft is planning impending layoffs affecting up to 2.5% of its workforce.
That is a direct cost optimization pivot. They are actively reallocating capital away from human resources to fund physical compute.
Yeah. And the second update is a glaring red flag regarding the financing environment. On Wednesday at 4:12 p.m. Eastern Time, reports broke that SoftBank is pursuing a massive $10 billion margin loan backed by its OpenAI stake.
Taking a $10 billion margin loan against private market shares in a rising interest rate environment is like the definition of top-of-the-cycle leverage.
It really is.
If the valuation of that private AI collateral drops, or if liquidity in the private markets dries up, SoftBank faces margin calls. To meet those calls, they'd be forced to liquidate their public equity holdings.
It creates a mechanism for private market tech exuberance to trigger systemic contagion in the public markets.
Absolutely validates the recent institutional warnings regarding AI-driven debt exuberance.
Now, shifting away from tech, we saw significant friction reported in global trade and supply chains. USTR Greer announced on Tuesday at 6:02 p.m. Eastern Time that the USMCA will not be renewed in its current form, and they are shifting to rolling talks.
That injects severe regulatory uncertainty directly into regional auto and manufacturing supply chains.
And compounding the supply chain chaos, as of Wednesday at 3:54 p.m. Eastern Time, Apple is lobbying the Trump administration to buy memory chips from CXMT.
Which is a blacklisted Chinese company.
Yeah.
The Pentagon literally lists CXMT as a Chinese military company. But the underlying mechanics explain Apple's desperation here. Memory chip margins are compressing drastically.
Right.
Apple is being forced to choose between supply chain security and keeping their consumer hardware pricing competitive in a tight macroeconomic environment. They need cheap components so badly they are willing to lobby against a national security blacklist to get them.
The macroeconomic environment is actively punishing companies that rely on globalized, frictionless trade.
It's a brutal operating environment. Which actually brings us to our dedicated closing bell joke.
Oh boy, let's hear it.
So with Fed Chair Warsh officially abandoning forward guidance today, we are all left navigating this choppy market completely in the dark. I mean, the action was so wild that gold swung a massive $158 intraday, making our portfolios look less like stable investments and more like an EKG monitor.
Yeah, that's accurate.
But on the bright side, at least the government cleared Anthropic's new Claude Fable 5 AI models for export. That way, since the Fed won't give us any guidance on where rates are heading, we can just pay an AI bot to hallucinate some rate cuts for us.
We might actually need those hallucinations by the end of the week, honestly. Let's look at what to watch next on the calendar for Thursday, July 2.
What are we looking at?
The main macroeconomic catalyst for the entire week hits at 8:30 a.m. Eastern Time with the release of June non-farm payrolls and the unemployment rate.
A hot payrolls print validates Warsh's hawkish reset, while a significant miss forces the market to frantically price in a recessionary pivot without any Fed guidance to anchor it.
Exactly. Also at 8:30 a.m. Eastern Time, we get weekly jobless claims. Following that, at 10 a.m. Eastern Time, May's factory orders are released.
Right.
And this is the most critical structural dynamic for tomorrow's session. At 2 p.m. Eastern Time, U.S. bond markets close early ahead of the Independence Day holiday. That will drastically reduce afternoon liquidity.
A high-stakes jobs print in the morning, followed by an evaporation of liquidity in the afternoon. That is a dangerous combination.
Yeah, it is.